Hey, welcome back to Right on the Money, your go-to resource for the financial topics that matter to you. Now, if you're just joining us, we're here with Erik Bowman, owner of Bowman Financial Strategies. We're talking about his new book, and we're also talking about, in this segment, we're going to be talking about how to avoid costly retirement tax traps. I think it's a fair statement, an accurate statement, that we all believe in paying our fair share. We just don't want to pay $1 more than that. Wouldn't you agree, Erik?
I would totally agree with
that. All
that.
right. If you're just tuning in, you got to back up an episode and make sure that you get your copy of this amazing book that Erik put out. Congratulations on this again. Amazon or your website.
The Retirement Tax Revolution.
The Retirement Tax Revolution. All right. So in this book, we're going to dive right back in. In this book, you talk about the Tax Torpedo surprise.
Right.
And this is a tax hit that catches a lot of retirees off guard. What is it? Why is it so dangerous?
The Tax Torpedo goes to how taking taxable income from one source can increase the taxation of other sources. In particular, the provisional income calculation that determines how much of your Social Security is subject to taxation is one of the drivers that could ultimately put you in the 49% or more effective marginal tax bracket. And what happens is, through the very complex way they calculate taxation on Social Security, up to 85% of your Social Security is taxable. It starts out at zero taxable, but then other income streams like IRA distributions will not only create a taxable event for the IRA distribution, but will increase the taxability of Social Security based on how that formula is created.
All these things all interplay.
They all interconnect.
Okay, so let me ask you this. So many people focus on growing their 401k. They focus on their IRAs, but in the book you say that saving in the wrong way can create tax problems later. So what do you mean by that?
Yeah, I mean, if you save into your 401k, I mean, there's some rationale for that. I've got a lot of expenses, raising a family. I need the most net income possible, paying for college and so forth. So I put in pre-tax money into a 401k so I net more income into my checking account. And that makes sense. I understand that. But if that's all you've done and then you enter into retirement and 100% of your assets are in pre-tax money, that means 100% of your distributions are subject to taxation, which means you're not only subject to tax risk, but legislative risk, that they could change the rules. And as they change those rules, you will have no option to make adjustments because you're sitting there with all taxable money. So one of the best ways to offset that risk is at the right point in time, and it's going to be different for everybody, we need to be building up buckets of money, a diverse set of accounts by taxability. Some taxable money, some tax-free money, some subject to capital gains tax, another type of taxation. And now you have a selection that you can synchronize to get the money you need and pay the least amount of tax as possible.
This is a darn good book.
We get into it.
All right, so in the book you mentioned RMDs, required minimum distributions.
Right.
What are they? And then why do they often push retirees into the higher tax bracket?
Yeah, so they are required. They are the minimum amount you can take out, and they are a distribution. So, required minimum distribution. People lose the meaning of words sometimes. Think RMD, required minimum distribution. What's that? It's literally the required distribution, the minimum amount you have to take out of an account as ordained by the government. So the government says, you have to take this percentage of your IRA as a distribution, depending on your year of birth. It might be 70 and a half, 72, 73, or 75. They changed the rules a lot lately. But what happens is if you only have pre-tax money and you've done nothing to diversify the taxation of your accounts, like Roth conversions, for example, very powerful strategy, then you are simply going to be beholden to every future tax law change, whether good or bad, for the rest of your life. And your required minimum distributions, since they are based on the account value of your combined IRAs, could be much greater than what you need for your expenses. So that means you could be paying taxes on money that you don't even need right now. That in and of itself sounds like a bad strategy.
So speaking of strategy, so Social Security and money, Social Security is often thought of as tax-free money. in the book, you say that's not necessarily true. So
Right.
if that's not true, how can people avoid paying more taxes on their benefit than they have to?
Right. Social Security under current law, a maximum of 85% of your Social Security could be subject to taxation. That number is determined by something called the provisional income calculation. Sometimes it's called the combined income calculation. The bottom line is they look at all of your other income sources, such as capital gains, dividends, interest, ordinary income, combine these together, go through a fancy calculation, and say this is how much of your Social Security is taxable. If you look at that formula, you're going to notice that there are some components like Roth, not in the formula. So if you make a Roth distribution, it's still money that hits your checking account, but you don't pay any taxes on it, and it does not increase the taxability of Social Security. Other income streams that might cause a capital gain, for example. Well, that capital gain, you don't have to incur it this year. You could wait till next year, meaning you have control over the timing of when you exercise a sale of a holding that would trigger a capital gain, which means now you have some control over how much of your Social Security may be taxable.
As you're talking, and I'm listening, and I'm thinking about when I read the book, being a DIYer is out the window.
I would agree. It's so people have no, DIYers come into the fold because they have no idea how complex it is. And then once they realize the complexities, they make one of two decisions. One of them is, I'm going to seek out a professional to help me with this. They have the software, the experience, the repetitions to get this right and give me a more optimal outcome. The other ones, head in the sand and hope. They literally hope that the decisions they make are going to work out okay in their favor.
Perfect segue. If someone is already retired, hasn't done any tax planning, is it too late?
Absolutely not.
Absolutely
The
not.
fantastic thing is Roth conversions. When done at the right time in those first couple years of retirement, like imagine you say, I'm doing it, I'm going to retire in March of this year. The first thing that pops into my mind is, well, that means we have 9 months of no income from employment, and we could fill up your tax bucket, which is kind of an analogy I have of how are we taxed, what's the final outcome of our taxability going to be, and we have choices of how we're going to fill up those marginal tax brackets, and we're not preordained to have to take them out of a specific source, meaning we have control over that, and we could potentially do more Roth conversions in the first few years of retirement and pay more efficient taxes on those Roth conversions than we could have ever done when we had dual income coming into the house and all these other potential expenses. Now you can actually do that in a kind of a cleaner chalkboard, like you're starting from scratch and you can understand the implications more clearly.
So if I'm watching right now,
Yeah.
and I'm like, that guy right there, I need to talk to that guy. What's the best way? Email, phone number?
If you go to our website, we have a really nice, clean booking page, my big smiling face on there, and you can just schedule a brief meeting where we can understand what your situation is, determine if I can help, and if I can help, what the next step would look like.
I like it. Speaking of next steps, Erik, we are going to come back. Erik is going to share with us a surprising trick that proves how easy it is to believe something that isn't true. Including the way we think about taxes in retirement. It is called the yield sign trick, and you don't want to miss that. We'll see you on the other side of the break.